This is a recorded lecture on exchange rates. I'm taking a very practical view on exchange rates. The idea is to think about when we look at currencies, when we look at the prices of currencies, how do we think about the numbers that relate the value of two currencies? How do we think about their movements? Can we think about the future movements of those values? So what I plan to do is to go through about 2 or 3 different frameworks or theories to think about exchange rates. Each of them has sort of a slightly different perspective, but what you will see is that at some point the 3 of them come together. Particularly at the end, I'll try to sort of wrap up everything and give you sort of a unified view of exchange rates. Now, let me start with the basics, which is sort of defining exchange rates. Now, defining exchange rates takes 2 steps. First, defining what we call nominal exchange rates, and then defining what we call real exchange rates. The nominal exchange rates is the easy one, because nominal exchange rates is just the price of 2 currencies, the relative price of 2 currencies. So typically we say how many units of a foreign currency you have to give me to buy 1 unit of a domestic currency. Now realize that the way I'm going to define these exchange rates, the way I'm doing it now, if the number goes up, it means my currency is stronger, and I'll use the expression appreciate. If the number goes down, my currency is weaker, and I'll use the expression depreciate. Now the second concept, which says, let's take this number, the nominal exchange rate, and adjust it by prices. For that, I'm going to talk about the real exchange rate. Now this is a formula that I'll use a couple of times during my presentation. Now, what I want you to see here is the real exchange rate is simply a measure of the cost of living. Let me write it here. Why is it the cost of living? Because I take the prices that are called P, which are the prices of goods in my country. Imagine I'm in Singapore. These are prices in Singapore dollars in Singapore. How much does it cost me to buy a typical basket? I want to see whether these prices are higher or lower than the same prices in another country. Let me call that France. So the F is for foreign, in this case also for France. Now those prices come in euros. And what I do is I have to do a ratio of them that makes sense. And for that I need to have the nominal exchange rate in the numerator, that's the E with the N. That nominal exchange rate converts the Singapore dollars into euros in the numerator, so I get a ratio of 2 things in euros, so now the number is very meaningful. Imagine that number happened to be 1.07. Now what does that number tell you? It tells you that Singapore, which is the country's the numerator, is 7% more expensive than France. So we're going to use this as a fundamental concept in exchange rates, because prices, when we think about prices and we compare them across countries, those things have meanings. Can I buy the same good in another country at a cheaper or a more expensive price? That is something that has a meaning to all of us. We're going to start there, and from there we're going to go to a place that sounds more like currencies and nominal exchange rates. Now, let me start with sort of what I'm going to call the first theory, the law of one price. Now, imagine a world where there is a lot of arbitrage in goods. So you want to buy a good, you can buy it in Singapore, in France, in Brazil, in South Africa. And as long as you can buy it everywhere, you're going to have enough arbitrage and you're going to create enough competition for companies to end up having the same price everywhere. Now, if that is true, using a little bit my formulas, what would happen? The real exchange rate will be equal to 1 everywhere, because that's what the real exchange rate is, just the cost of living. And if you look at the formula of the real exchange rate, is the nominal multiplied by the ratio of prices. But for that to be equal to 1, it has to be that the nominal is simply the inverse of those prices. So mechanically what we said is, here is a fundamental theory about the real exchange rate, but that fundamental theory says something about how currencies should price. The price of currency should match the price of goods that we see out there. Now, this is a very simple theory. If you look at this theory, look at the last formula, what it's saying is you want to understand currencies, you need to understand prices, inflation. Because if you understand how those 2 prices move, you should be able to understand currencies. Now, let me take this formula a little bit for a test. I'm going to test this formula with 2 things. One is the price of an iPhone across the world. The other one is the price of a Big Mac, which is the McDonald's hamburger that is sold also everywhere in the world. Now, I went to a website that has this comparison of prices across countries. And what I'm showing you here is the price of an iPhone, a particular iPhone 14 Pro, 128 gig of memory across a few countries. Now, what this website does is it puts everything into US dollars so you can compare the prices across different countries. Now, if you stare at those 5 prices that I have in front of you, 1,055, 1,063, 1,100, these prices are quite close to each other. It feels that our simple theory that says the real exchange rate has to be 1 or is 1 seems to fit very well this story. Now, some of you might notice small differences, but you could argue those small differences can be justified by arbitrage cost. So it is not 100% free to say, let me go to another country to buy a phone. It's not always easy to import it. There can also be small tax differences that explains those prices away. So first pass, we look at a good like the iPhone, and it seems to fit our story, real exchange rate equal 1. Now let's look at a second price, which is now from a Big Mac, the hamburger that McDonald's sells. Now what you see here is lots of dots. All those are prices of Big Macs in different countries. The US is made the reference, so you see the US around 0, and then you have a range of prices which are either higher or lower than the US, the Big Mac in the US, that can range from a very high number to a very low number. Now I give you a couple of examples. In Switzerland, if you want to buy a Big Mac, you're going to pay 35.4% more than in the US. Second example, in Egypt, if you want to buy a Big Mac, you can buy 65% cheaper than the US. Now, what do I see here? I see a range of prices, which is very different, very, very different from what we saw in the iPhone. Now, why? Why here we do not see this low of 1 price? Now, there's many reasons you can think of. You can think about McDonald's have a different way of pricing than Apple for the iPhones. You can think about the taste for hamburgers varies in ways that the taste for iPhones does not. Now, do not go there. Those are important considerations, but those are minor considerations here. There's something more fundamental. The law of 1 price will only work if there's enough arbitrage. Now, enough arbitrage means that the good can be shipped from one country to the other and bought in a different country. For the iPhone, that logic works quite well. It might not be perfect, but it works quite well. For the Big Mac, that doesn't work. You cannot go and buy Big Macs in Egypt and ship them to Switzerland. You cannot be in Switzerland saying, let's go for a meal, let's take a plane to Egypt and then come back. That arbitrage just simply does not exist. Therefore, if you think about the law of 1 price, it should not apply to this chart. So here we're a little bit lost because we started with a theory that says, wait, we have a sense of what prices should look like. We check with the iPhone, it worked quite well. Now we come here and we say, wait, our theory should not work, and indeed it doesn't work. Now I need a slightly more sophisticated theory. This is what I'm going to call my second theory, that tries to think about what is different in Egypt. What is different in Switzerland, and how does that affect the price of a Big Mac? Now, I'm going to do something very simple. Here comes my theory number 2. I'm going to bring an argument which is straightforward, which is about the level of development of these 2 countries. Now, I'm not going to use Egypt and Switzerland. I'm going to switch countries. I'm going to have Spain and Germany, 2 European countries, different level of development. Spain, poorer, low GDP per capita. Germany, higher, high GDP per capita. Now, where is the level of development coming from? From productivity. Spain is less productive than Germany. This is the discussion we had during our session 2 in class. Now, I'm going to summarize the productivity by using the number of hours it takes for a worker to produce one of 2 goods. So I'm going to bring 2 goods into the story. I'm not going to bring the iPhone because neither Germany nor Spain produce iPhones. Let me bring cars. So I'm going to think about the car as the equivalent of the iPhone. What do I mean by that? A good that can cross borders, that can be traded. Now here are my numbers. It says the Spanish workers are not very productive in this sector. It takes them 2,000 hours to produce 1 car. The same car in Germany can be produced with 1,000 hours. Now here you see a massive difference in productivity, thus how the GDP per capita in Germany is higher. I'll bring a second good. I'll bring my Big Mac again. Now, Big Macs are being served both in Spain and Germany. McDonald's is everywhere, including those two countries. I'm going to make an assumption, which is the productivity there is quite similar across the two countries. You don't see large differences. In other words, I'm going to put the same number that says productivity, it takes 0.2 hours to deliver a Big Mac in Spain, same amount in Germany. Now, these numbers are sort of round numbers to help us make some calculations here. There's nothing that says these are the actual numbers, but I just want to tell you a very simple story that then will help us understand a lot of the data. Now, let's think about what we know now. First, we need one number which is important to do any calculation. What is the price of that car that I'm referring to? I'm talking about the same car being produced in both countries. I'm going to say this is a car that costs 20,000 euros. That number is arbitrary. It's just to fix prices somewhere and make a quick calculation. Now, here are the two calculations I need to do now. First, what happens to wages? Now, think about it. The German worker can produce 20,000 euros of value by working 1,000 hours. I'm going to give this value to the worker, so the German worker will be able to get 20 euros per hour worked. The Spanish worker, being half as productive, can only collect 10 euros per hour. Now, nothing here revolutionary. You're a country that is richer, you're going to be able to pay more to your workers. I'm just doing some calculations so you can see actual numbers. Now comes the next step. I'm McDonald's. If I'm in Germany, I need to hire workers which are more expensive. How much is the cost of producing a Big Mac? So take the 20 euros. You know that it takes 0.2 hours to deliver the Big Mac. 0.2 times 20 euros, it means the cost for McDonald's is 4 euros. The same calculation in Spain, because the wages are lower, the cost is only 2 euros. Now, what did I do? I created these very large differences in the Big Mac, while there are no differences in the car. What happened to the car? The car can be arbitraged away. So I cannot even start thinking about what should be the price of the car in Spain versus Germany. As long as there's arbitrage, it will have to be the same. With the Big Macs, there was no arbitrage, so I have to think about pricing in a very different way, and I'm thinking about cost. What are the costs coming from? From wages. What are the wages coming from? From productivity. So here comes now my conclusion. My conclusion is, if I look at these two countries, the real exchange rate, if I take the perspective of Spain, so I'm going to call Spain the home country, prices in Spain multiplied by the nominal exchange rate divided by prices in Germany, this number is going to be lower than 1. In other words, the cost of living in Spain is just cheaper. Now, that's what the real exchange rate is. So far, what we did is we sort of created now a new anchor, a new theory for the real exchange rate. It shouldn't be 1. It is 1 for cars, but it's less than 1 for Big Macs. Now, none of this should be, once again, too surprising. When you travel the world, for those of you who are based here in Singapore, if you go to Malaysia or if you go to Vietnam, that's what the world looks like. The iPhone costs the same in Vietnam as in Singapore. Going out for a meal is a lot cheaper in Vietnam. Hiring a nanny is a lot cheaper in Vietnam. So you have these price differences that sort of feed this story. Now, let's take this story for a spin. What do I mean by that? Let's move things. So far, things are very static. Yes, prices are cheaper in countries that are poorer. Let's try to move these numbers. Now, this is what I'm going to do. Let's put a scenario in front of us that we have discussed before in our class, which is the notion of convergence. If you're a poor country, you catch up with the rich countries. Now, here's what I want you to think about. The sum real exchange rate between my country and the other countries. Let's take the Spain, Germany examples. Imagine Spain is catching up with Germany in productivity. What are we going to see? Higher wages, higher prices for McDonald's. Why? Because McDonald's has to now pay the higher cost of these wages. Therefore, the real exchange rate will have to go up. So that's a fundamental conclusion. Countries that are poor, that are growing very fast, are likely to see their price levels get closer and closer to the price levels of the rich countries. Now, that is not just a theory, that's a fact when you look at the data. Now, the interesting part is when you open that formula, because now I see the price of Spain, the price of Germany, and the nominal exchange rate. Now, what am I saying? The left-hand side has to go up. Of course, the right-hand side has to go up. How is it going to happen? There's three variables. How is it going to happen? Now, in this particular example, there's a very easy answer because I've chosen two countries that share a currency. So the number that says EN, the nominal exchange rate, is always 1. There's no exchange rate, in fact, so that number is fixed at 1. So what has to happen if you stare at that ratio is that prices in Spain are moving faster than in Germany. Now, we can say that using the word inflation. We expect in this example, inflation in Spain to be higher than in Germany. So here, we did not make a prediction about the currency because there's no currency. But we get an intuition about relative prices, which country is going to become more expensive, and we start seeing once again the importance of inflation to make a statement about these relative prices. Now, let's elevate this example to a more realistic, interesting case, but also slightly more complicated. So I'll keep all the logic that I had before. Let me switch countries. Now, let me make China the poorer, less productive country. Let me make the US the richer, more productive country. Same story. Let's start from 0. The real exchange rate in China is likely to be lower or lower than 1 compared to the US. China has a low price level compared to the US, that's a fact. China has been converging to the US, is likely to continue converging going forward. We have seen, we will see more, China becoming more expensive relative to the US. Using my words of today's session, the real exchange rate will go up. Now comes the interesting part. How is that going to happen? Let's open up the box or the definition of the real exchange rate. Now, there's 3 terms here. Let's think about what we know and what we don't know yet. We know that the denominator in those prices is the price of the US. Now, we have a central bank in the US that says that number is likely to move at 2% every year. So now see that number moving up at 2%. Now, if you look at what is going on, the left-hand side has to go up, the right-hand side has to go up. So there's 2 terms left. They better move up faster than 2%. Now, which one of the 2 is going to move up? Now, here I want you to think about 3 scenarios. Scenario number 1, the Central Bank of China, and here the central banks are key, says fix exchange rates. So scenario number 1 says fixed exchange rates, which says fixed nominal exchange rate, that EN cannot move. What is the conclusion in this case? Same as the Spanish-German case, because we almost replicated the same story. We know that inflation in China will end up being higher than inflation in the US. It's the same story. I'm not going to say much about the currency because it's fixed, but I can once again bring inflation to sort of close the argument and make sense out of these equations. Second case. What if the Central Bank of China said, I like an inflation target of 2% like the US. I want to be like all the others. So I am going to shoot for inflation of 2% in China. Again, that's a possibility. Many countries have 2% inflation targets. Now, if you look at the formula, the price in China grows at the same rate as the price in the US. So the ratio of the 2 prices doesn't move. So what has to happen? The currency has to appreciate. Here we're talking in nominal terms. So this is the actual nominal exchange rate, what you see in the newspapers when people quote exchange rates. So now I expect a currency to go up in time. Very different scenario. Now we sort of get inflation at the same level, the prices don't do much for you, the currency does everything. Now let me do a third case which feels a little bit complicated, but is also relevant for many emerging markets. What if the central bank in China, it is not good at controlling inflation? I'm gonna throw a crazy number here. Let's say that inflation is way too high, 10% every year. Now, in this case, once again, if you look at the formula, the price in China is just growing really, really fast. It's making China, in some sense, too expensive, more than what is needed. Now, how do you get the right increase on the real exchange rate, the left-hand side? If the price in China is growing too fast, the currency might depreciate to get you to the right place. Now, what did I do? I gave you 3 scenarios which are very realistic. A central bank that fixes the exchange rate, the exchange rate will be fixed. There's nothing else to say. A central bank in this situation that chooses an inflation rate which is similar to other countries will see the currency go up. A central bank that chooses an inflation rate which is clearly above what other countries do, the currency will go down. Now, I see examples like this everywhere. China, for example, has been somewhere between scenario number 1 and number 2. Sometimes obsessed with fixing the exchange rates, sometimes a lot more about controlling inflation and let the currency appreciate, which they've done a few times over the last couple of decades. Scenario number 3 looks a little bit more like India. A country that is growing, productivity is growing, the real exchange rate is going up, but because inflation is very high, the nominal has to depreciate to get the right amount of real exchange rate appreciation. Now, let's take a pause here and make sure that we all agree what we've seen. We've seen a theory to understand currencies, the nominal exchange rate. It says you need to tell me 2 things to understand currencies. Productivity growth relative to other countries. Am I growing faster or not than other countries? And central bank policies. These 2 things combine in an equation that you have in front of you, and if you put them in the right place, you get a sense of what nominal exchange rates, the value of the currency, should do over the long term. Now, to make this very concrete, let me give you 2 examples. I'm going to show you 2 examples that look different and that I think will help us sort of solidify our intuition. Let me start with a group of countries that have had, in the past, productivity growth was very similar. So let's start with countries that sort of look similar when it comes to productivity growth. Now, this is the way you should think about it. Step number 1, similar productivity growth. You can now say something about the real exchange rate. In particular, the real exchange rate should stay constant, should not move. Okay, that's our first intuition. Now, we don't want to talk just about the real exchange rate, we want to say something about the nominal. So now write down the formula. So remember, P is for my price, PF is for the foreign price. Now, the whole thing has to stay stable. Now, it could be that everything is the same, so nothing moves, that's easy. But imagine you and I have different inflation rates. My inflation rate, because of my central bank, is higher than yours. Then the ratio of prices is going to go up because my price moves faster than yours. Now, how can I make the whole thing constant? There's only one way to do it. My currency has to depreciate to get stability on the real exchange rate. Now, let me show you the data that goes with that. This is data that goes back to the 1970s, 80s, and 90s. Why those years? Because we used to have big differences in inflation, so it's an interesting episode. These are countries that are mostly advanced, with similar productivity growth, with one exception, South Africa. But South Africa happens to be an emerging market that did not converge. Therefore, productivity growth was not fast. Now, let's read the data. I'll start with South Africa. South Africa had 7% more inflation than the US on average. So the US is going to be once again my reference here. What happened to their currency? The South African rand, it depreciated depreciated by a similar amount. So here you see the two arrows, prices going up, currency going down by the same amount. The real exchange rate stayed constant. Same pattern for everyone else. Your inflation is 3 percentage points higher than mine, your currency depreciates by 3 percentage points. So what you see here is only one message and only one. Real exchange rates have to be constant when productivity growth is the same. Inflation differentials must be compensated by the nominal exchange rate. That's it. Let's look at the second case, which is more interesting because more things are moving. Two countries, different productivity growth. Very different scenario now, because now we have to say something about the real exchange rate. Now, let me take those two countries, Japan versus the US. Now, I'm going back to the 1960s and 70s and 80s and 90s. That realm gives you a sense of productivity in Japan relative to the US. Now, these are the years where productivity caught up in Japan relative to the US. So faster productivity growth rates in Japan. Now, if I look at my logic, the real exchange rate of Japan, the cost of living of Japan must have increased. There, I don't have any inflation yet. The only thing that I'm saying is because of productivity growth, real exchange rate has to increase. Now comes the interesting question. How did that happen? The real exchange rate went up, but what happened to the currency? Now that depends on the central banks. Now, what did the Central Bank of Japan say? They say we want an inflation rate that looks similar to the US. Now, what happened if you look at the formula? That ratio that is there is not going to move that much. So that ratio is going to be quite stable. It's not going to give you much action. The only way for Japan to see a real exchange rate appreciation must have been through a currency going up. This is the currency, the nominal exchange rate. Now let's check both things. First, here on this slide, I have the real exchange rate. So that's the cost of living in Japan. The left-hand side, did it go up with productivity? It did. That's what we expected. Now let's look at the value of the currency. This is not the real exchange rate, this is the nominal. Now what is this? This is how many yens you need to give me to buy $1. So be careful with the way the scale works. It used to be, back in the 1970s, that you had to give me 350 yen to buy $1. By the end of the convergence, which is mostly in the 1990s, that number had gone down to about 100. So this is a massive appreciation. You can be careful with arrows here. The massive appreciation of the Japanese currency. By the end of that arrow, I can buy $1 with just 100 yen. Therefore, the yen is a lot more valuable. So all the pieces fit. Higher productivity growth, real exchange rate appreciation, similar inflation. There's only one way to get the real exchange rate appreciation, which is a nominal appreciation. Now, that's the second theory that I wanted to add here, which, as you can see, brings two things together: productivity growth and central bank policies. You combine the two in the way that I'm showing you here, you get a sense, and a forecast, if you want, of nominal exchange rate. What are we missing? We're missing a third piece, which is by far the most volatile and sometimes difficult to understand. Let me show you two exchange rates here. Australia to the US dollar, Australian dollar to the US dollar, British pound to the US dollar. Two lines. A dotted line. What is the dotted line? It is an exchange rate implied by the theory that I just gave you in the previous slides. Bring productivity, bring inflation into the mix. What type of exchange rate would you predict during these years? Now, what do you see? You see a line, both of the blue dotted lines, which are quite stable. Why? Because these productivity numbers don't move that much. Inflation does not jump every day. Now, what is the green line? The green line is the actual exchange rate. Now, Unfortunately, the two lines don't look the same. If they did look the same, we would be done. We'd have a perfect theory. In particular, what I want you to see is there are all these periods where we seem to deviate in a way that looks a lot like a spike. So things go down or up, and then later they reverse and go back to the trend. So there is a sense of a trend, which is a fundamental one, driven by productivity and inflation. But then there's a sense of volatility. Now, how do we explain that? How do we explain that volatility? There we need to change our chip. Let's not think about arbitraging goods, the law of one price, productivity. Let's think about currencies as assets. I'm sitting here as an investor. If I put my money in the US, can I get a better return than if I put it in Malaysia? Now, that has nothing to do with productivity. I'm just trying to get some short-term gains by buying and selling currencies and getting some return in both countries. Now, how do I think about the world in that environment? Let me just read these bullet points slowly for you. So the first thing is, if I'm sitting here thinking, should I put my money in the US? Should I put my money in Indonesia? Should I put my money in Argentina? I see different returns in different countries. Those returns in my course, we call them the interest rate. So today I see an interest rate in the US as I'm recording this session that is 5%. So if I put my money in the US, I can get 5%. Now, can I do better somewhere else? No, therefore I'm gonna go to the US. Now, how do we expect currencies to react? Now, let me read the next two bullet points. They're quite obvious, but in some sense they contradict each other, but let me tell you they don't. First statement. Imagine the central bank of the US tomorrow shows up and says, look, the interest rate is not 5 anymore, it's 6. Now, what would the capital market do? Is like, wait, it's higher than what I thought. Let me run to the US, buy the US dollar, and the currency will appreciate. Now, this makes a lot of sense. We see it all the time, and it's just about investors reacting to interest rates to get the best returns, and prices have to move. And those prices are the exchange rate. Now, here comes the possible confusion. Does that mean, does that sentence mean that if today I look at the world and I see countries with high interest rates, low interest rates, does it mean that I should always go to the high interest rate countries because that's where I can get the highest return? That's not true. In fact, quite the opposite. Here comes what is confusing. Give me two countries. Give me a country like South Africa. South Africa has higher interest rates than the euro area. But you have to ask yourself why. Why are those interest rates always higher in South Africa? Because they have high inflation. And if you go back to my fundamental theories a second ago, high inflation means depreciating currency. The currency has to go down. So I don't want to invest in a country whose currency is going to go down. I'll get some extra interest rate, but then the currency will kill those returns. Therefore, seeing high interest rates around the world does not say I should go there to get a higher return. Now, how do you make these two statements compatible? First, I said high interest rates, appreciation. Now I say high interest rates, high inflation, depreciation. Now, the big thing is what is red here. You have to separate what is news to you, to the market, versus what is not news. Very simple. Two countries where there's no news. Your country always has higher interest rate than mine. How do I see the currency moving? Your currency is likely to depreciate, go down. Why? Because if you have high interest rates, it's because you have high inflation. So I don't see any motivation to go to your country because that's sort of the trend that you see of a currency that depreciates all the time. Let's bring something that now sounds like news. Your central bank today surprises me, the market, and they say, guess what? We're raising the interest rate. more above what you thought we were going to do yesterday. Now, in that case, there are news. The exchange rate, like any other asset, needs to be repriced. I now find your country more attractive than what I thought yesterday. That was not priced anywhere. Let me run to your country and buy your currency. Your currency will go up. So you can see, you have to understand the difference between two scenarios. Life on a normal day where there's no news, high interest rates, likely to be related to high inflation, currency depreciating. News, that's the key word here. News about high interest rates, higher than what we all thought, will likely to cause a capital inflow and an appreciation of the currency. Now, let me finish just with a reflection on all the theories that I gave you and try to put them together. There's a set of fundamental theories that give you a sense of that trend. That trend for currencies is driven by two things: productivity, which is related to level of development and catching up, and inflation, which is related to policies of the central bank. So you draw a trend which is very much influenced by those two factors in a way that is very mechanical using that formula that I gave you. Around that trend, we have volatility. That volatility is caused by what? By news. And there you think about pricing currencies as assets. If somehow the path of interest rates has changed because the central bank has surprised us, then think like this: higher interest rates, news about higher interest rates are likely to cause a capital inflow that reprices the asset, the currency, up. And that is going to be the volatility around the trend that is going to make our theories look a lot closer to the data that you see in the rest, that data that you see when you plot the exchange rate, which is a lot more volatile than those slow moving trends. So if you keep those theories in mind and you look at the data, you can explain a big chunk of what you see in the data. Can you explain everything? No, because when markets reprice news, sometimes they might be more volatile than any of our theories. Because when we reprice anything, markets have their own views, and sometimes they overreact, sometimes they underreact. So don't expect to have a line that says, here, now I can explain every single movement. That is not true for you, for me, for anyone who thinks about exchange rates. But if you stare at the numbers today and you look at these trends and these patterns of volatility, if you just use these two basic theories, you're going to be able to match the majority of the movements you see.